Welcome to the March webinar for Altos Research. Am I buying at the top of the market? I got a text the other day from a friend. They've been shopping and they are afraid. Am I buying at the top of the market? In fact, I think every home buyer ever probably asked that question. Am I buying at the top of the market? I know I asked it when I bought. I remember buying 20 years ago in Silicon Valley for the first time I bought in Silicon Valley. And as I like to say, that was 2 bubbles ago. And the NASDAQ bubble had burst, but the housing market hadn't adjusted very much yet. And I'm about 30 years old. I'm about to have a really big mortgage. Am I buying at the top of the market? And of course, you know, it's such a universal question. It actually was a question that led me to create Altos Research to begin with. At the time, there was no way to see what was going on in the market. Every once in a while, an agent would have some kind of information. The really good realtors would know it in their bones, but the rare few could really communicate that to a home buyer like me. Am I buying at the top of the market? And what I ended up doing was I had to create Altos Research to answer that question for myself, to analyze every home on the market in the neighborhood and changes in pricing and understand where things were happening. In that bubble, it turned out that as the NASDAQ exploded, blew up and dropped, the very top of the Silicon Valley market came way down. Median price in Silicon Valley, in our neighborhood of Silicon Valley, fell by 1/3 in 2003. But where I'd bought, I went at the lowest point of the highest neighborhood I could be in. It didn't go down at all. And that information was critical to me. It was important as nobody could have explained that to me except the data at the time. And at the time, nobody had the data. Altos Research didn't exist yet. And so you can imagine right now, all of our home buyers and stuff, it's the craziest, highest demand point we've ever measured. They've all got to be asking, am I buying at the top of the market? So then the question is, how are you communicating? How are we communicating to them what they need to know? Maybe it is the top of the market. Maybe that doesn't matter if they're buying for the long term. If they can afford the house, it's the top of the market, but they've got the cheapest mortgage of all time and the payments are affordable. Maybe it doesn't matter that they're buying at the top of the market, but they are afraid. So keep that in mind as we're talking today, as this really important question for both your buyers and your sellers, and how you're going to use the data to communicate to them. Am I buying at the top of the market? Let's dive in and look at some data, shall we? We are in the real estate crisis. The inventory crisis. We have the fewest homes available and the most buyers available. We actually have more transactions happening and no selection. It's insane. So what we're going to do today is talk about the current data. We're going to then look at some of the policy and some of the other impacts. There are 5 characteristics that created the inventory crisis over the last decade. And we'll look at those 5 characteristics. And then we'll dive into some of the local data. Before I get rolling on the data, I like to share this link. If you are in the business of real estate and you need to communicate to buyers and sellers, you should reference our new ebook. This is how to use market data in your real estate business. It's about communicating, but it's also about building the business, investing in your business. If you're investing in your real estate business right now, this probably belongs in your arsenal. There is a link to get that ebook. It's in the chat, get posted in the chat. So go click through, get that ebook if you haven't had it. And as we're talking, the other opportunity is to book some time with our team when you're thinking about your local markets and how you're building your business. Book some time with our team so that you can explore all those great opportunities. Okay, on to the data. Current conditions, the market, the crazy market, and where we're headed, the 5 factors of the inventory crisis, and then the local looks. You may have seen 2 weeks ago, a nice big spread in the New York Times where they were using our inventory data to help explain to the country what's going on out there. And this is our chart of active inventory in the whole country. We're down to only 318,000 homes available. Now, what's happening, of course, is that there are so many getting offers so quickly. They're essentially bypassing the active market and they're just going directly into contract. So there's a lot of throughput happening and no selection for buyers. The important trends I like to point out in the inventory metric is that every year through the decade, we've had fewer and fewer homes for sale at the beginning of the year. What's happening is more and more properties are going into investment properties, to being second home purchases, to being where the first home is held when the buyer buys the second home. As rates are really low, it's become a really good deal to do this, to double up like this. You keep your first home for an investment property, and when you buy the second property. Right now, with rates, when rates last month are under 3%, 2.6%, it becomes really affordable to hold 2 mortgages, when even a year and a half ago, you could have only afforded 1 mortgage. It's a powerful phenomenon that's been happening through the entire decade. The only time that inventory has climbed year over year was this period between January of 2018 and January 2019. We went from 790,000 to 826. This is single family for sale at any given moment is what this chart is showing. And when this went up this year, this corresponded to a rise in interest rates from 3.8 to 4.8% in 2018. So, and the reason I point that out is because we are super interest rate sensitive right now. And it's something that you and your buyers and sellers are going to need to keep their eye on to check when the market changes. And I'll show you how we can keep our eye on that in our local market to help consumers take action more quickly. This week pricing, the median home price in the US is up to $355,500. It is up week over week as expected this time of year. We should have all the way through the end of June. Will be nice price appreciation. We are already baked into the year easily 10% year over year price increases. So it's a remarkable year, a 2-year stretch of home price increases. That's the red line here on this chart. The gray-green line here is the price of the newly listed cohort. If you've seen me talk about the data, this newly listed cohort is each week, all the new listings that come to market. And these listings are the ones that are the most sensitive to actual demand levels. So for you as a listing agent, a selling agent, and the sellers selling their homes, you're taking all the signal around you. You know that there's multiple offers down the street, and you know that you can list it just a little bit higher each week. And so you can see the steepness of this climb each year really shows us how the demand is shaping up for the year. These have been all the last 5, 6, 7 years have been strong demand years, strong years for price increases, for growing equity in the US housing market. And this year is the strongest of them all. So we're up to 345,000 on the new listings cohort this week. Very, very strong. Usually the new listings tops in April, for the market top in May and June, and then it'll start backing. So the strongest inventory coming to market right now, the next 6 weeks or so. And we'll see that again. And the question that we don't know yet is 2020 defied all kinds of seasonality. There was no winter downturn. And as rates have been super low and demand super high, will we see some seasonality, a little bit of back off on that? We don't yet know. Maybe the most important stat for us to keep in mind this year is that homeowners in the US have gained $1.5 trillion in equity this year. That's wealth. That is wealth with lower mortgage payments than they've had maybe ever, relative. And so like this is a powerful driver of the economy. It's a powerful driver of new transactions. And it also is, if you've heard us talk, why there's still no sign of distressed sales, of any foreclosures happening from people who couldn't make their mortgage payment throughout the year because of the pandemic. We have a little bit of data on actually what's the latest on what's happening there, but this is the key in the market. The other places that we got to keep our eye on this year are all these indicators of demand. When we look at the active market, one of the most important demand signals is the percentage of homes on the market that have required a price cut. So typically it's about a third, 35% of homes get overpriced and then they take a cut before they sell. Nationally, that's a heuristic, a rule of thumb. In times when demand weakens, all of a sudden it's 35 to 40%, 45% of homes take a price cut. When demand is hotter, now it's 25 or 20% in the super hot markets. And you can see this cycle that we've been in between 25 and 35% over the last few years. And then, of course, this year, price reductions just falling through the floor. These were at 17% of homes on the market with price reduction. So that means a third of folks are overpriced, like they know it, or they're trying, let's see what happens. Let's try to get as much as we can, and they list really high. And normal, if a third of them normally do, only 17%, only half of those are actually taking a cut because the rest of them are getting the price they're asking. So that is our indicator, one of our indicators with the highest demand we can absolutely see ever. However, when the market changes, at some point it will change. You'll see it here first as these price reductions start ticking up. Now, they normally tick up in the second quarter anyway. And so they're going to climb as we get later in the year. Some seasonality will be coming in, but then we're going to watch the steepness of this curve. So in 2018, the last time we had rising rates, you could see a steeper climb and a higher peak than we'd had all year. So more people taking price cuts. All of a sudden they're in July and they said, uh-oh, what happened to our demand? there's a lot less than we expected. Let's cut our price. We have to cut our price to move it. And all of a sudden, more of them had to cut their price. We started 2019 with higher price cuts, and then we've declined from there. And so that's the signal we're going to be looking for. You're going to see it in things like the price reductions data before you see it anywhere else. And you'll need to use it to motivate your buyers to take action, your sellers to take action, because the market will be cooling. The inverse of that are the price increases. The price increases here are flips, or other investment properties. Typically, they're purchased, they're held, they're remodeled, they're maybe relisted about 90 days later at a higher price. And this typically you can see over the years 2 to 5% range. All of a sudden last year, the market started heating way up and the speculation climbs dramatically. So there are lots of places. My friend Ryan Lundquist in Sacramento talked about a home that had a 35% price increase in 90 days that he was tracking in Sacramento. 35%. And so Sacramento as a whole has, I think, about 5% of the homes, 6% of the homes on the market that are currently relisted at a higher price. So they're like the flips. Nationally, we're at 7.7%. This point in March, the end of March each year, typically marks our seasonal high for flips. That's because things were on the market maybe before the holidays, and now they're coming back into as they're relisted in a stronger market, and so in the spring market, and so they come on at a higher price. So typically we have this seasonal peak. Last year, though, we defied all seasonality, and so the price increases started climbing in the fall. And this is when people thought that they thought it was going to be a weak pandemic market, and it turned out to be a strong one. So they had bought, and then they came back on and resold at a higher price. That's what's going on right now. And now this spring, of course, has been the craziest that we've measured in a long time. I don't have this measure in 2005 and 2006, the peak of the subprime frenzy, but it was somewhere up here at that point as well. So it's a little worrisome, but it's also what you'll see. We should see that start to plateau and decline a little bit during the year and see if we get back into healthy rules. One thing to keep in mind, just yesterday, Fannie Mae issued some new rules on investment properties. And it sounds like the implications are going to be that mortgages for second homes and investment properties will be suddenly significantly more expensive. It's going to be fascinating to see how that impacts the flips, because if these are investment properties, the mortgages, the cost of doing this will likely increase. So, and that sounds like that's going to kick in like right away, like April 1. So keep your eye on the percent of active listings with price increases. If you are an agent in an area with active investors, investment activity, that's going to, it could very quickly dampen demand on those properties. Now, we're in the face of the craziest demand ever, so maybe it just makes it healthy. We'll have to keep an eye on that number. That's percent of listings with price increases. If you're an Altos Research subscriber, you'll be familiar with the Market Action Index. This is where we can take all these other numbers, supply and demand, and we turn it into one at-a-glance number. And the way we like to say it is, are you a big geek or a little geek? If you're a big geek, we got lots of data for you. But if you're just a little geek, when you look at your Altos report, I want you to look at one number. I would like you to look at this Market Action Index. It's like a speedometer. When that thing goes higher, it's because supply is tighter, demand is higher. When it goes lower, that's because supply is building in weaker demand. And the fascinating thing here is, of course, we're in this strong sellers market, that nationally we're in as strong a sellers market as we've ever seen. It's inventory is tight. People are buying everything in sight. And so you can see over time how all of a sudden we are way up here. And I'll show you, it looks to us, I was just looking through the data as we were preparing for this conversation today. And Seattle, to me, looks like the hottest market in the country right now. And I'll show you how that shows up in the market action index. But when you have your Altos reports, guide your buyers and sellers to say, like, look, while we have your house listed, I want you to keep your eye on this one number. Or while you're shopping, if this number is up here in strong sellers market, that means if we find the property, you've got to take action quickly. So you use that in your conversation to help people make decisions that are going to work for them. And we'll look at some of the market action index and some of the local markets when we get to there. Days on market. So when we're looking at days on market, time on the market, normally a strong seasonal pattern, which peaks in the fall because the stuff is sitting around the longest time. And then we get fresh inventory in January and February and March, and days on market, the market time falls. Normally, interesting, last few years, 84 days was what we'd be at in early March, and as the market's heating up. But right now we're at only 49 days. And you, of course, I'm sure see that around you, that you're in markets where it's like, well, things are on the market for 1 day, 5 days, 0 days. And so this is as a national, all price points. So, including all the super top price points as well. And I'll show you in a minute how we look at in your price range and in your client's price range, and we can really see where that demand is happening. In fact, here, when we look in the price range quartiles, you can see in this market that we grabbed, the high end of the market here is 1.8 million, 70 days. The low end, anything under 500 is going essentially immediately. And so you can see exactly where, and basically anything under $1 million in this market is going immediately. And it's only the stuff that's, around 2 that's taking your time. So when you're talking to buyers and sellers, you say, yes, the median days of market's 49 days, but look, in your price range, it's 0. it's going right now. And really, this will capture any of the stuff that's like, well, it was listed for a few hours, or it was listed, on the market for a day. It's nuts. Absolutely crazy in that sense. But this is how you use it, right? So this is how you communicate that to your clients. Every Altos report has these price range segments that you can then use to work with your buyers and sellers on that topic. Okay, let's talk about the 5 trends that have led us to this inventory crisis. You might have seen an article that I wrote for Inman News last week, and we captured them in that article. The 5 areas, and the most important thing to keep in mind about our inventory crisis right now is that these are decade-long trends. Almost all of our inventory crisis is from the problems that we've been facing for a decade, and not actually associated with the pandemic, surprisingly. So we have ultra low rates. We have the lowest rates ever. Rates have been falling for a decade, with the exception of that little stretch in 2018. When rates went under 3% a year ago, that was the rocket fuel for this economy. Like they took off. So that low rates, drives demand, but it also drives supply. And when I talk about demand and supply driven by low rates here, the phenomenon I call is doubling up, meaning I am going to keep my first home when I go to buy my new home. I'm going to keep my first one for investment property. Maybe I've added an ADU to it, and now I have extra revenue. And so the low rates are driving both demand and supply. It's what you might call buy low, sell never. And so buy low, sell never, because it's been a really good year for income on my my homes. So what I'd like to do, I'm going to try a poll today. I'm going to try, and the thing I'm interested in of recent buyer transactions, or like transactions in the last year that you've been a part of, like how often are folks keeping that investment, that first home, as as their investment property? Um, I can imagine on the nevers on some of these, especially if you're focused on first time home buyers as your niche, they aren't there yet. Um, but the sometimes and frequently is a big part of the market. And in fact, sometimes and frequently, we're looking like as that happens, people do that. Like it's a really good time to do. It has been a really good time to do that. When rates are at 2.6%, we can see that transaction. Um, yeah. Okay. I'll end the poll there. So 66% of the time, like we're seeing a lot of people do this doubling up, keeping their initial home for investment for income, because between things like adding record numbers of ADUs and Airbnb, it's been a strong rental market. That has been a really good time for individuals to keep that second home for investment property. That's a phenomenon that is low rates restrict supply. So low rates push demand, but they also restrict supply, because when your mortgage is at 2.6%, like it's really easy to make rental income on a property with that lower mortgage rate. And people do it. So that's been a big driver of what's going on with inventory. The third factor is underbuilding. And we came out of the bubble, the mortgage bubble crisis, when and we and home builders had to cut way back. They had to sell land. We've had tighter immigration, so there aren't as many people to like. Labor is super tight for home builders. So all of these factors have contributed to underbuilding. And we went from historically from 1.5 million homes per year, new construction, down to 500,000 and in the early part of the decade. And then that's only recently 700,000. And finally now we're back at historical averages. And that's like 30-year historical averages. And so we're underbuilt for a decade. And if it's 500,000 homes a year, 5, 6, 7 million homes that we didn't build. And then demographics, I'll show you a quick thing on demographics. And then we're going to talk about the policy. So homeowner focused policy as opposed to home seller or supply focused policy. Uh, on mortgage rates, the thing that's going to be fascinating the next few months is where rates go from here. We went from 2.6% a few weeks ago. We're now at 3.1% as of this week, 3.089 or something like that on the 30-year fixed. When we look at demand, as of March, this rate increase is actually accelerating demand. The buyers now locked in February at 2.6%. And they say the buyers now are saying, I got to overbid now to get my mortgage and to get my payment, lowest payment ever. So it's actually accelerating demand and may continue to accelerate demand in through the next couple months, especially if buyers anticipate rates climbing more from here. Why would rates climb? Rates would climb because the economy is super hot. And in many places, we have this weird economy where we still have a lot of unemployment, but in the home buyer segment, there is a lot of growth. The stimulus has passed. So a lot of economic stimulus going into the market this year. And so all of these factors, as the economy is expanding, drives the bond rates higher, which ultimately leads to mortgage rates. So while I don't have we don't have data that predicts where mortgage rates are going. It sure looks like a soaring economy will likely lead us off these very low points. What's unclear is what the threshold is when consumers think it's too expensive. I've mentioned a few times this rate rise here, especially this one in 2018, when rates went from 3.8% to 4.8%, 4.9%. This rate rise, uh, when we went significantly over the long-term average, that slowed demand and it added to supply. So inventory climbed year over year, price reductions climbed steeply, the price appreciation slowed. So this is a big move, this big move here, and it's over the long-term average. What's uncertain is whether right now, do consumers start reacting at 3.5%? Do they start reacting at 4? It's not sure. But that's the number we're going to keep our eye on. It's going to affect both supply and demand. I talked about demographics. I talk about it a lot. When your clients are asking, am I buying at the top of the market? When they are afraid, one of the important things to remind them is that the millennials are moving into their mid 30s. There's more of them than anybody else in history. And that's their peak earning and home buying years. So anybody buying now, while prices may move up and down, the long-term trends are bullish for housing. There are more buyers coming down the pike than there have been ever. So we don't, while the demand doesn't, the demographics doesn't necessarily drive pricing, when they're afraid of, am I buying at the top of the market? It is good to point out that the trend is in their favor. Okay, let's talk really quickly about how policy has driven us into this inventory crisis. I like to point out that all housing policy is essentially aimed at helping the home owner. Helping a person stay in the home, helping them make owning the home more affordable. And, that starts with the mortgage deduction. It starts with the property tax freeze. So in California, that's Prop 13, but a lot of areas have property tax freezes for seniors so that grandma doesn't get kicked out of their house because of rising home prices. But if we're protecting grandma in her house, so she doesn't have to sell because she can't afford the property taxes, if she doesn't have to sell, she doesn't sell. And as a result, if she doesn't sell, there's less inventory, and that drives prices more. So all the tax policy is aimed at helping people hold onto more houses. And the more that happens, the more people hold, the fewer homes. The mortgage forbearance program worked exactly as it was designed to do, which kept people in their homes. We can see right now that about 5% are exiting the forbearance program by selling into this great demand time. Those are people who maybe said, we went from 2 incomes to 1 income, and we're never going to be able to afford this mortgage again. So about 5% of them are selling. Most people are doing a renegotiation, or they're just resuming and they're paying the back for the year and they're just starting fresh. Less than 1%, just a tiny fraction, are doing some kind of short sale or other distressed sale, deed in lieu. Almost nobody is doing that. And so, if you've heard me talk about this phenomenon, a year ago, we expected a lot of distressed sales, but it turns out none, right? And it's none because we gained $1.5 trillion of equity in the last year. Everybody's got equity, and when you have equity, you don't walk away and you don't have a short sale. You just sell your house, or you figure out a way to hold on to it. And that's mostly what's going on, is people are figuring out a way to hold on to it. And then finally, the home buyer tax credit is not a function of homeowners, but it stimulates demand, as opposed to any policy that stimulates supply. So the supply-oriented policies tend to be focused on like apartment building or infill, and they're really, really hard to come by. So all of our policy, all of the major policy, and the administration, it barely matters. It is still about how do we keep people in their homes? How do we give homeowners the best deal possible? Okay, let's do this. I am going to switch over to a screen here, and we will share this. We'll share a little local data. We have a few minutes to share a little local data. This is the back end of the Altos system. If you're not an Altos client, you should join us. Go to altosresearch.com and just book a time with us so that we can help you answer these questions for your clients. I'm looking here, I'm just looking at all the views, who's viewing which reports. We can see where they are viewing all these reports and who they're coming. But let's dive into some local data. I'm going to start actually with my Zoom towns. So the Zoom towns, if you'll remember, this is some of the remote work markets that, because we could Zoom, we went to really some places where normally would be vacation or second homes. And here's why I'm bringing these up. The Zoom towns had massive price appreciation this year. And that was one of the big surprises of the year. Like, you would imagine in an economy that locked down that people wouldn't be buying second homes, but it turns out they bought in droves. I just have two. Truckee, the two that are most close to me in California and San Francisco. Truckee is Lake Tahoe. And what you can see, you can see the price trends, normal seasonal patterns, a little bit of rise and falls. And then last year just exploded, just absolutely exploded in pricing. But as Fannie Mae changes mortgage policy, it could make mortgages on second homes in places like Truckee or Bend, Oregon is the other one I have up, could make them less affordable, make the payments higher. So we're going to keep our eye on price decreases and, of course, the price ranges. But looking at price decreases right now, only 6% of the active market in Truckee has taken a price cut. Remember, normally that's 35% would take a price cut. And we can look over time at price decreases here. And we can see, normally 35% this time of year, 30% last year, 6%. So if that changes, we will see it here first. Let's look at Bend, Oregon for another one that's comparable. Bend has 13% price decreases, super strong seller's market. And you can see, so Bend normally is in this 30 to 50% range. Bend went in as a more seasonal market. And then last year, no seasonality at all. And we're down at 12, 13%. So this is what we're going to keep in mind. This is the Zoomtown phenomenon of the year. This was what happened when people said, I'm leaving LA, I'm leaving San Francisco, I'm buying in a place where I like to be anyway. That was what was going on. And the Zoomtowns, are Hudson Valley, they're Cape Cod, they're Palm Springs, they're all over the country, but there's the remote workers could work remote, and that's where they bought. So that's going to be fascinating to see if, for example, that Fannie Mae change impacts that during the year. I have a few other markets open. Um, Here's Phoenix. Phoenix is in a space where only 16% price decreases. This is price increases here in Phoenix. So these are our flips. And, Phoenix is an active investor market, has a lot of things like investment properties, a lot of flips going on. And last year started the year very strong. We had our pandemic lockdown when people backed out and then they jumped back in and drove. So 7-8% here in Phoenix. Phoenix, though, is less active right now than some other areas, more affordable areas, even. So I was looking at Birmingham, Alabama, 17% with price increases because the median price in Birmingham is under 300K. All these markets are strong sellers markets. And you can see price over time in Birmingham. You can see in the price range segments exactly where the demand is. So in Birmingham, the 700 range is still a few months, but anything under 400 is going very quickly. But this is interesting. So Birmingham here. Oh, and let's look at Tarrant County. So outside of Dallas, massive year on in price appreciation outside of Dallas, and the price increases there. Massive investor activity, right? The median price is only 350. You can come in from out of town with cash, easy financing, do investor and flip activities in places like Tarrant County. And so that's been, as rates have been super low, you can see that activity. Possibly the hottest market in the country right now is Seattle. If you look at our market action index, like we are accelerating, or almost the weekly readings are like pegged at 100. The smoothed out is 90. Like it is so that everything is going so fast. This is all of the greater Seattle area. 7 days on market average or median, and only 10% price increases. Because Seattle's a more expensive market, you have less flip activity. So only 4% on the flip side. But then look at this, anything under $1 million in Seattle, 7 days, just bam, 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 as fast as you can imagine. Over $1 million, is still only 40, $2 million, still only 40 days. Seattle may be the hottest market in the country right now, which is kind of interesting because Seattle had a little bit of the Zoomtown. People left Seattle for remote. They left the city of Seattle for remote during the year. But right now, Seattle just has tons. I have a few more open here in Orlando. So Orlando is a market that has typically higher price reductions and also is not quite as on the increase side. So, but had massive price appreciation year, especially with a lot of inbound immigration from more of the more expensive East Coast cities. And you can see that things at the lower prices in Orlando. 3 weeks, not 0 days, but 3 weeks. So you can see how that changes in a place like Orlando. I have Charlotte open here. Charlotte has had, is down 21 days, median days on market. Price decreases are at 14%. Price increases are at 15%. So there's a lot of like iBuyer activity, a lot of investor activity in the Charlotte area. And of course, inventory just falling through the floor. And you can see big spikes in pricing. In Charlotte, anything under $1 million is just moving so quickly. But even over $1 million, only 2 months. So it's Charlotte has that inbound from New York, from more expensive like New York and Boston, but also has inbound from California. So that drives a lot of that. And then the last one I have open today is Cincinnati, just because I was talking to a friend in Cincinnati there. And I'm always interested to look at, Cincinnati is not like Charlotte or Phoenix, which have these long-term demographic growth trends. Cincinnati has some regional pull, but it's not an in-migration market. But even in Cincinnati, we're in a strong seller's market. We have inventory tightening. Price decreases are only at 19%. And days on market is only 56%. So you can see price decreases. Here's normal seasonality in Cincinnati. 30 to 40%. That's a normal range. A third of homes overpriced. Let's try it, and then they take a cut before they sell. And then last year started hot and stayed hot forever. And now we're at 18%. So this is a number where we want to keep our eye during the year. If rising rates lead to some demand backing off, you'll start to see it in numbers like this soon. That's the quick whirlwind tour of the local data. If you've seen me speak over the years, you might have heard me say this. There are only 3 questions in real estate. What's for sale? How much is the house worth? And how's the market? And when I say there's only these 3 questions, it's because that's what the consumer needs to know. That's what the consumer is asking. What's for sale is pretty straightforward. There's nothing for sale. It's very tight. If you want it, you got to go as soon as it comes on the market. How much is my house worth? That's an exciting one right now because people are surprised at how much their house is worth. Potential sellers are, really? Could I really get that much for my home? And how's the market? How's the market is everything else. Is it a good time? Am I buying at the peak? Remember, everyone is asking, am I buying at the peak of the market? And we use the data, use the market reports to communicate to your buyers and sellers exactly what they need to know. And it's not just about communicating to them. It's like, this is the craziest market ever. And when you come to them with the data, you are established as their expert. So if you are investing in your real estate business this year, if you think it's a good time to build your business, which I think it is, I have a simple recommendation for you. I recommend you just go to altosresearch.com and book a session with our team. Let's look at the data for your local market. Let's talk about how you integrate market reports and market data into all parts of your marketing, all parts of your lead gen and lead nurture. A lot of times people come to us, and you hear a lot in the real estate industry about lead gen. I like to talk more about lead nurture because these people and they're in your sphere and they are worried. Am I buying at the top of the market? How are you going to communicate to them what the opportunities are? We can use market data. So I recommend you go to altosresearch.com, book a session with our team so that we can get you rolling if you are investing in your real estate business this year. Okay, that's all we have time for today. As always, I thank you for joining us, and stay tuned. Stay tuned to the YouTube channel for our weekly videos. And I love you. I appreciate all of you and all of your attention. Thank you so much.